If you want to see what an actual human-sized turd looks like, here you go! Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of September 27th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Last week was pretty tough at the beginning of the week in the stock market. We had a massive dump on Monday, and this isn't the first time unpalatable Chinese has resulted in a huge dump. Thankfully, the rest of the week did recover as we got some sort of positive news on the US economy. Basically, you know, rates aren't going to be touched because everything still sucks, and the earnings from last week were pretty solid, actually better than expected for a lot of the big companies that were reporting. So that ended up kind of leading to everything going higher. There was mixed news coming out of China about Evergrande. To be clear, Evergrande is still the largest story going on in the markets right now. I'm going to touch on it this week. I've got a couple of stories, like, it can't really be avoided. You have to talk about it. But honestly, personally, I'm getting a little tired of it because it just seems to be negative news after negative news and there's no immediate resolution. So I'm going to cover a couple stories on Evergrande, but I'm not going to dwell on it. It's just going to be kind of hit the headlines, move on. Let's get started with the news. First news story. Amazon says workers and applicants fired or barred during marijuana screening are now eligible for employment. Amazon said it has reinstated the employment eligibility for former workers or applicants who were fired or deferred during marijuana screenings. Amazon ended pre-employment marijuana screenings for most job applicants in June, and the company is also lobbying the federal government to legalize marijuana. It appears that Amazon is so desperate for employees that they've actually turned to lobbying the federal government for legalization of marijuana so that they can get employees everywhere. They're removing the requirement for drug tests and screenings for employment. They're bringing back employees that were previously barred for marijuana violations, and the only marijuana violations they're keeping in place are those that are held by DOT, the Department of Transportation, for positions like truck drivers. So Amazon is doing everything in its power to bring employees in. I think it was last week or the week before I mentioned Amazon also increased their minimum wage to like $18 an hour, and they were offering signing bonuses up to $3,000 for certain positions in certain areas. I mean, Amazon is desperate for workers right now, and this is yet another piece of evidence that they just really want anybody to come in. So if you're one of my viewers and you partake in the green and you're looking for a job, check out Amazon. They're desperate for employment, especially if you're in one of those states in which they're offering the signing bonuses. All right, here we go. Evergrande, let's just do it. Let's get it out of the way so I can move on to some other stuff. There were mixed messages coming out of China this week regarding Evergrande. I'm not sure if this is the news cycle becoming faster and faster and reporters failing to double check or verify their sources, or it's possible the Chinese Communist Party is leaking mixed information to keep everybody off balance regarding the situation and what's going on. I don't actually know what's happening here, but on September 22nd and September 23rd, consecutive days, we had completely divergent stories released about this situation. China Evergrande Group's main unit, Hengda Real Estate Group, said on Wednesday that it would make bond interest payments on September 23rd. In a statement, they said it would make the coupon payment on its Shenzhen traded 5.8% September 2025 bond. Okay, so this was kind of the good news, but I think the market reacted unnecessarily positively to this one because we had people, I mean, even online, if you look at Reddit, if you look at Twitter, people are like, oh, it's fine, nothing's gonna happen with Evergrande. That 5.8% bond payment, the interest payment, it was only for onshore investors, not offshore, which means all of the international investors were still screwed. And that interest payment was only for about $36 million, and they still missed about $83 million in offshore bond interest payments. Yikes. Now, nothing bad happens immediately. They technically have 30 days to make the payment before they reach default status, so we don't really know what's happening yet, but this doesn't exactly instill any type of confidence whatsoever because they have tens of billions of dollars worth of debt, and they only managed to make a $36 million interest payment while missing an $83 million payment. So the market's giant green happy candle when this news was released, I think was a little bit unfounded. Now, on the 22nd, we also had imminent China Evergrande deal will see the CCP take control. Sources close to the Chinese government have told Asia markets a deal that will see China Evergrande restructured into 3 separate entities is currently being finalized by the CCP, and it could be announced within days. State-owned enterprises will underpin the restructure, effectively transforming the property developer into a state-owned enterprise. And the deal is being designed to protect Chinese nationals who have bought apartments from Evergrande, like the ones you see protesting on the streets, and also those who have invested in Evergrande's wealth management products. The big thing is stemming any widespread economic flow-on effects that insolvency would cause on the Chinese economy. Regardless of whether this is true or not, because the next day we got different news, let's take a look at this and what it actually shows. It shows that China is going to make Evergrande a state-owned company. Now, this is not a first. If you look at any of the large Chinese corporations, especially those affiliated with infrastructure, nearly all of them are state-owned, so this would really just add Evergrande to the state-owned portfolio. 2, the interests here are protecting Chinese nationals. This doesn't say anything about international investors, and also it mentions protecting them from any type of flow-on issues in the country. So if this article is actually true, then it shows that China's interests are only in protecting what's happening inside its own borders, which, let's be real, nobody's surprised about that at all. However, the next day, Wall Street Journal reported China asked local governments to get ready for the possible collapse of Evergrande. I don't know about you, but possible collapse sounds a whole lot different than restructuring. This is a completely different message coming out of the CCP, and I don't know what to believe here because there's literally one day separating these 2 articles. So I guess this is a choose your own adventure game where everybody loses. Chinese authorities are asking local governments to prepare for the potential downfall of China Evergrande Group, according to officials familiar with discussions, signaling a reluctance to bail out the debt-saddled property developer while bracing for any economic and social fallout from the company's travails. Economic and social fallout. Social fallout makes me think that this is also talking about protecting the Chinese nationals who purchased apartments, and economic would be protecting the other corporations that are owed money by Evergrande. Local governments have been tasked with preventing unrest and mitigating the ripple effect on home buyers and the broader economy, for example by limiting job losses, scenarios that have grown in likelihood as Evergrande's situation has worsened. The underlying message here is actually the same. We have the Chinese party interested in stopping economic ripples within their own country and in protecting Chinese nationals. So even though we have totally divergent 180-degree headlines where in one article China is going to restructure Evergrande and in the other article China is going to be warning people, hey, it's going to collapse. In both articles we have consistency here in that China is going to be limiting the economic ripples in its own country and protecting its own nationals. In the eyes of the Chinese government, if you're a foreign investor in Evergrande, screw you guys, it doesn't matter. They only care about their own citizens. So, not really sure what's happening in the situation, but at least you get the idea on the general stance of the Chinese government. Chinese Estates, which is Evergrande's second largest shareholder, plans a complete exit of their investment. Chinese Estates, which owns 6.5% of Evergrande's equity capital as of September 10th, sold $32 million worth of its Evergrande stake. It said it already sold 108.91 million shares, or about 0.8% of its share capital, and the company estimated that if the entire stake is sold, it will realize a loss of about 1.22 billion US dollars for the year ending December 2021. This is a vote of no confidence, and you can see even internally in China, people are just walking away from this dumpster fire. Next story from Forbes, Evergrande chairman Hui Kaiyan, 100% likelihood I did not say that correctly, has been paid $8 billion in cash while property developer piled on debt. Wow, amazing. Rich guy gets richer in a crisis. Although Evergrande Group's 80% stock decline so far this year has made a dent in its billionaire founder and chairman's fortune, he will remain extraordinarily wealthy even if the company collapses under the weight of its more than $300 billion in debt. Of his currently estimated $11.5 billion fortune, Forbes calculated that $8 billion is from cash dividends paid to Hui since Evergrande's 2009 IPO on the Hong Kong Stock Exchange. Hui owns a 77% stake in the company. Damn, that's crazy. I feel like that's actually criminal, but hey, whatever. The only reason that I'm talking about this is because there's been news stories about how Evergrande employees were being asked by the company to go without accepting their monthly payment, and it wasn't really a request, it was more like a threat where they would actually just lose their jobs if they opted to take their salary. So you have a situation here where one of China's largest largest employers were threatening its employees with holding salary, and its billionaire owner was still collecting dividends from the 77% stake in the company. Now, I am as capitalistic as it comes, and I believe that everybody is entitled to their money, but there is a certain sense of morality here where, holy shit, my dude, you're sitting on $11.5 billion right now. Your company can't even make interest payments to stay afloat and not default. You could easily cover the interest payments at least for the next year from your fortune, from the dividends you've collected on this company, and you have the balls to ask your employees, your middle class, lower class employees in China, to not collect their salary under threat of being fired. Holy shit. If you want to see what an actual human-sized turd looks like, here you go. Now, it's really hard to quantify how the Evergrande situation is affecting US stocks, but one thing we can do is look at the largest asset manager in the world, BlackRock. Now, BlackRock is long on a lot of Chinese positions. In fact, BlackRock has one of the highest exposures, if not the highest exposure, for the 3 largest bonds sold by Evergrande. Since this news story broke, BlackRock had really just hit a top of about $960, and since the Evergrande situation has been blowing up, BlackRock ended up hitting a low of about $839, so it ended up losing about a ninth of its value, a little over a ninth of its value at the lowest point. We're back up to 874, 877 after hours. Now, I understand that one of these was an XD day in here where we had paid out a $4.13 dividend per share. So the stock price did drop $4.13, but this goes way beyond the XD drop. And this is much more serious than that. So BlackRock, they're long on the position in Evergrande, in China in general. Their share price is hurting. Now let's switch it up to some non-China news. Thank God. Although maybe God wouldn't really approve of this next segment. What is Centerfold? Now this is from Playboy, published on Medium. Playboy is creating a service called Centerfold, our new creator-led digital platform dedicated to creative freedom, artistic expression, and sex positivity. Centerfold will serve as a home for the world's top creators to interact directly with their fans and expand their communities and commerce business, and we expect the platform to roll out in the coming months. Sex positive content creators interacting directly with their fans and creating communities. What does this sound like? Holy crap. Playboy's making OnlyFans version 2. Why does it matter, you might ask? I thought OnlyFans was great, you might say. Well, if you didn't know, a couple weeks ago on this channel, I covered how OnlyFans is banning sexually explicit content from its platform. This is going to lead to a mass migration of content creators looking for somewhere else to go. Centerfold comes with one of the largest, most well-recognized brands in the world, Playboy. Actually, if you look up the world's most recognized brands, I think Playboy's like rank 17 or something like that as of the last list that I saw. You have one of the most recognized brands offering an OnlyFans-like service called Centerfold. What do you think's gonna happen here? I'm gonna call it right now. There's going to be a huge, massive migration of content creators from OnlyFans heading over to Centerfold in hopes that they don't lose their fan base. And this is probably going to happen very quickly, basically as soon as the service opens, coinciding with OnlyFans shutting down. There's actually a really compelling investment thesis for Playboy, and I'm not going to take time to go over it in this video. If you go to Twitter and you follow at Buddy_Barker, that's at BUDDY_BARKER, on September 22nd, he posted a tweet thread, and this is like 40 some slides, 43 slides. He did a financial analysis. He did research on why Playboy is a compelling investment. It's a cool read. I mean, I'm personally not convinced enough to invest into it right now, but I could definitely see why some people would be, especially with the Centerfold news. It's even more so on my radar. I really wish compelling DD and theses were not presented on a 43 tweet thread. Good Lord, that was uncomfortable to read. Twitter is not an ideal platform for long form. Let's just leave it there. If we take a look at the chart for Playboy, they went public through a SPAC merger back in September of 2020. They reached a high of about $63, and this was in May at the height of the NFT craze, and since then we've come back down to about $25.62. It looks like about $20 is a pretty solid floor here for Playboy, so we're actually not that far off the support if you are interested in taking a position because of Centerfold. This isn't financial advice, but hey, it could be worth, you know, a small position in your portfolio as sort of a gamble type play. Last week, I mentioned Costco's earnings report and how I believed they were going to be amazing. Now, my reasons were mostly just anecdotal about Costco just being slammed. Costco earnings report came out and they were amazing. Costco stock gains on Q4 earnings beat will limit key item purchases among COVID disruption. Will limit key item purchases? Uh-oh. Costco said it'll limit purchases on certain key items in the months ahead amid what it called an uptick in Delta-related demand. This is from supply chain issues. Yeah, okay, we know that's happening. So whatever. Oh, financials. The quarter sales rose 17% from last year to a street-beating $62.68 billion, while comparable sales rose by a better-than-expected 9.4%, paced by increases in Canada and the United States. Membership fees rose 11.7%. The group earned $3.76 per share for the period, up 23.7% from last year, and well ahead of the Wall Street consensus forecasts, even though gross margins fell 10.9% thanks to rising COVID and supply chain costs. That's insane! A 23.7% gain on EPS beating expectations despite the fact that gross margins increased by 10.7%. Wow! Wow, I mean, obviously, if gross margins stayed the same, it's not directly proportionate, but we would be looking at something like probably a 30+% beat on EPS for a $200+ billion market cap company. That's pretty nuts. Looking into the final months of the calendar year, Costco said it plans for product delays linked to both COVID and supply chain disruptions, adding to delivery times. Suppliers have got plenty of merchandise, but there's 2 or 3 week delays on getting it delivered because there's a limit on short-term changes trucking and delivery needs, so planning is crucial. Now, this is from CNBC. Costco, Nike, and FedEx are warning there's more inflation set to hit consumers as holiday approaches. This is due to shipping costs and supply chain bottlenecks. Companies have indicated that consumers, for now, are at least willing to take on higher prices. The cost to ship containers overseas has soared in recent months. Getting a 40-foot container from Shanghai to New York costs about $2,000 a year and a half ago, just before COVID. Now it runs about $16,000. That's a really big markup. Paper products have seen cost increases of 4% to 8%. Uh-oh, paper products. Uh-oh, guys. Toilet paper is gonna get rationed again. I don't know if I can handle this. Last time was traumatic. I think I'm still suffering from TPSD. Costco, the day after its earnings, just had this huge green candle, and the stock ended up gaining 3% in a single day on Friday. This is absolutely nutty. And Costco, in general, is just an incredibly great stock to hold. In March, we hit a low of about $307, but since then, it's just been on a tear. Even just since, if we go back to the COVID drop for Costco wasn't that severe because the big box stores ended up performing so well. We ended up hitting a low of about 264. So, I mean, this stock has just been performing incredibly throughout the pandemic, and with their membership number increases, I don't see that stopping anytime soon. Now, the next story is not really a news story, but it's important, I think, when we're doing our stock research to take a moment out and actually just learn something if we see valuable information presented in front of us. Now, I want to share with you guys a Reddit post, and the author of the Reddit post is user nobjos. He posted this in our stocks, and it is absolutely a compelling, well-researched read. The title of the post is, "Should You Follow Insider Transactions? I analyzed 4,000 plus insider trades and benchmarked the return against the S&P 500. Here's the results." Here's the results for his analysis. And he was pulling the data directly off of the SEC Form 4s, which are the insider reporting forms. He was very specific with the information he pulled. The C-suite, VPs, and presidents, and minimum transaction values of $100,000. So this was very significant purchases. His results showed that in every time period he analyzed, 1 week, 1 month, 3 months, 6 months, 1 year, insider purchases on stock returns have outperformed the S&P by a significant amount. I mean, he's turning up alphas here of 2%, 1.6%, 4.7, 5%, 17.6. This is absolutely incredible. If you followed the insider purchases, you would have beaten the SPY across all 5 different time frames. The alpha generated would have also increased with an increasing time frame with the insider purchase trades, beating the S&P 500 by a whopping 17.6% over the period of a year. This is impressive. This is really impressive. It's not that surprising if we really kind of stop and think about it. When we're doing DD on a company, one thing we like to see is insider buying, and one thing we hate to see is insider selling, because if people are confident, they put their money where their mouth is. And I think one thing that's really important here is you don't look at stock awards or you don't look at company payouts, but you actually want to look at stock purchases, which are denoted by a P, usually on Fintel. And you want to see where people are actually putting their their money, not company allocated money. But this isn't the first time that we've seen stuff like this, and there's been multiple studies over the years indicating this. It's just this one had a much greater scale than some of the other stuff that we've seen, and it was done by a Reddit user, which is really incredible. That's all well and good, but how do we use this? Like, how can you and I actually use this when making our trades? Well, you guys know I have my normal set of resources that I look at. I learned one thing from this Reddit post. There's another website that I'm going to add to my repertoire before I invest in a small cap company, especially a penny stock company. The reason I'm saying small cap or penny stock is because insider buys are a lot more indicative there because they're so volatile. The website is called openinsider.com. It pulls information from the SEC Form 4s, and just on the front page, there's an incredibly useful thing here. It's called cluster buys, and this shows you when multiple purchases are made by multiple insiders in a short period of time, and it shows you the price, the quantity. You can also search by ticker. You can search by the insider name. This is useful when you have entire funds that you want to look up, like maybe small cap funds. You could look at purchases, sales, grants, gifts, taxes, exercises, whatever. I think purchases and sales are the most telling because, again, this is people's own money. So if I look at this right away, I mean, if I'm looking at this, I'm going to see this stands out a lot. Like, we have a cluster buy with 8 different insiders purchasing stock for a company called Ryan Specialty Group Holdings. I don't know anything about this company. Okay, it hasn't been trading very long. That's a really short-term chart, and they're buying in about $23, but they increased their ownership by 26%. That's a really big increase. So if we go to Webull and take a look at the chart for this Ryan, this chart has been going up pretty solidly. It looks like the company IPO'd at the end of July. The IPO went as high as $28 on APO day, and we're sitting at about $33.75 right now with a high price of $35. If I look at the analysts right now, I'm seeing we're actually right about the average of the analyst projections, so that's not boding well. But the fact that 8 insiders bought in, that gives me more confidence than whatever the analysts are saying, because hey, the insiders know the company. If that many of them are purchasing stocks, there's got to be a reason for it. Now, again, this isn't buy advice. You know, I would still have to do a full DD into Ryan. I don't know anything about the company. I don't know why the insiders are buying, but you know, that's a really promising signal when that many people are buying in that short of an amount of time, that many shares. Those insiders bought in at like $23 a share, and it's currently valued at $33 a share. So something interesting is happening there. Next news story, Dynatronics Corporation reports fourth quarter and fiscal year 2021 financial results and business highlights. Total net sales of $12.2 million, gross profit margin of 19.1%, continued product net sales of $9.8 million, net income of $2.9 million compared to a net loss of $2.3 in the same quarter last year. No debt, zero balance on the line of credit, and a borrowing base of approximately $5 million at the end of quarter 4. Cash of $6 million at the end of quarter 4. I covered Dynatronics on a DD video this week. They beat their EPS projections by 433%, which is crazy. I ended up getting in my position on like the mid 120s, got out of my position on the mid 150s. I forget exactly, but it ended up being about a 20% gain for me in 2 days of holding. Absolutely incredible. I was so excited about it. The earnings report was everything that I thought it would be and more. And actually, there's been some price stability. I think it's holding around 157 right now. The company announced everything was looking great. The only thing I'm not super thrilled about, the gross margins are a little lower than I was expecting. And the gross margin change was a big catalyst for my long-term investment into them. So I still have not opened up my long-term position. I just executed the short-term trade with about 500 shares. It seems the gross margin is being affected by supply chain issues like with everybody else. So that could be something that gets turned around really quickly when the supply chain eventually does settle down. If we take a look at Dynatronics, this is the day that I actually released my video. It was on Tuesday before market open. We opened at 126 and we ended up going as high this week as $1.60 on Friday, which is absolutely incredible. We're sitting at $1.58 after market. So good for Dynatronics, but the RSI has hit a bit overbought. The MACD is really, really high. And even with those strong earnings, I'm still expecting the price to drop back off. And I'm sticking with my plan of purchasing in a full-size position around the $1.20 to $1.30 level. Let's take a look at the upcoming earnings for the week. Not a whole lot that I'm super excited about. iPower is a pretty cool hydroponics play. It's like kind of a backdoor weed play. We've got Micron. Micron's always an interesting earnings report for that industry. Cintas and Paychex are good for the job market, but I'm expecting those earnings to be a little bit down because the job market's been pretty bad. Worthington Industries, I covered them before. They're doing really great, solid growth company. Jefferies Bank, after after close on Thursday is an interesting one. Out of all of the financial institutions that I've looked into, Jefferies has very limited exposure to China relatively to the other financial institutions. So I'm wondering if Jefferies is going to come out of this one a little bit ahead of other financial institutions. CarMax before open on Thursday. As a shift investor, I'm always very interested to see what its competitors are doing in CarMax. This is kind of a funny one. Palatin is reporting before open on Wednesday. Palatin is like primarily a clinical stage biotech company. It's a biopharma company. They have one product for sale that like increases sex drive of women or something like that. I don't really remember. I haven't looked at the company in detail. And they have some other stuff in the pipeline for dry eyes. I don't know. But this company, I remember from a couple months back, I was seeing a bunch of stuff on like StockTwits and Twitter and Reddit, and people were like really pushing this one hard. And the last earnings report was a disaster. And I actually had to go back and look at the news because I couldn't remember exactly what happened with this one. I just remember that I was super not interested at all. So I went on to Webull and I looked up around the last earnings report and I found it. Palatin Technologies Q3 EPS of -2 cents beats their estimate of -4 cents, but the sales missed the estimate. Their sales were 88,000 and the estimate was for 1.28 million. So the company missed analyst estimates by 93%. Now, I'm not a rocket surgeon, but that sounds pretty awful, and I don't know how people could be that off with their estimates unless the company was kind of altering the figures internally and leading analysts to believe something else. I don't know, that's speculation, but this doesn't look good. But the company is also trading below $1 right now, which does not inspire any type of confidence whatsoever. We're sitting here at 46 cents a share for Palatin, and it's been below $1, so below the minimum threshold for the NYSE for a long time now. But Palatin's trading on the Amex, not the NYSE, so that really doesn't matter. As long as it's not registered on the NYSE, that minimum threshold price has no bearing. It's a bad look. That's it for me today. I hope you guys did enjoy the video. I will be releasing another video this week. That's why this video is a little bit shorter. It's going to be a research video, a trade idea. Not sure what day I'm getting it out, but it's not too time sensitive. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please like the video. Subscribe to the channel if you want to be alerted to all my content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Happy trading. I'll see you next time.